I don't know about providing anything that is that concrete. And there are a few things that I can say that are happening at the moment and will happen in the future. You've had about 9 hours of people talking at you, I think, in this lecture, and you've probably got about another hour to get through, so bear with me. And also, I think it's a really interesting time to be talking about this topic. I hope you're going to learn something in the next, I don't know, half an hour, 45 minutes. This is what I hope you're going to learn. I thought we would just level set on what stablecoins are. Maybe you're all experts in them, in which case I can go through that very quickly, but I know that that these are still quite a novel development. So I'll talk a bit about what stablecoins are and the different types of stablecoin, a little bit about where they fit into the overall kind of crypto ecosystem. I think it's useful to position that. Stablecoins have been in the news a fair amount over the last couple of years, certainly, and I want to talk about a couple of market events, particularly Terra Luna, and actually some of the recent dynamics with the SVB failure in the US. And then once we've done that, we'll be in good shape to talk about where stablecoins fit in the payment landscape. And I've got a couple of slides on Bitcoin, because I think it's always useful to address the kind of elephant that people think of when they think about crypto. And then finally, some thoughts on challenges and opportunities of using stablecoins. So that's what I hope you're going to get out of the next 30 minutes or 45 minutes. You can either do the smiley face or the sad face in your feedback forms to let me know how I did afterwards. We're going to finish off with some of the regulatory reforms. So the reason why this is so interesting as a time to talk about stablecoins is you can argue, you can have an entire conference about why the market's developed up to now. Is it because there's an interest in using private money? Is it because stablecoins can be used to settle smart contracts? And then you've just heard this morning about some pretty revolutionary changes to the payments landscape in Europe. So if we were to come back in kind of 3 years' time with some stablecoin regulation, with widespread instant payments, with digital euro, etc., would stablecoins still be the same as they are today? Would the market be any different? Okay, so that's what we're planning to do. Just in terms of how we're going to do that, so start off with what crypto and stablecoins are, talk a bit about the different types and characteristics, sort of comparing and contrasting what stablecoins need to demonstrate to be a viable means of payment, and then whether they stack up against that, market events, bit on Bitcoin, and then on regulation. What I propose to do is we'll stop just briefly at the end of each section. Tash, if that works, if there's any questions, because otherwise I'll just talk for 45 minutes and then you'll have saved up all your questions and maybe don't want to ask them at that point. Okay, so very brief primer on crypto and stablecoins. So what are stablecoins? So they're a type of digital asset or cryptocurrency. This typically, the value is pegged to something, and we'll talk a bit about what that is. I think they've been around for about 6 years. I think the first reference was actually to the DAI stablecoin in 2017. And as you've just heard, they are private money. So the big distinction here is, a digital euro or the current euro is sovereign, government-backed, whatever the term you want to use there, but we're talking about a private liability. Stablecoins, I think, were created to try and deal with some of this volatility that we see in other cryptocurrencies. You'll know how volatile something like Bitcoin, for example, is. So there's the market developed to provide some more stability, predictability there, and also to act between as a bit of a bridge between fiat currencies, so the euro and the US dollar, etc., and other digital assets. The idea, at least, is you've got some sort of behavior that we're familiar with sort of a fiat currency, but with some of the utility and the sort of innovation that you see in the crypto space. And they've been developed, at least the different types of stablecoin, to build that price stability into the way in which the stablecoin works, which we'll see. Probably a couple of the most prominent newsworthy cases for stablecoins. You'll have heard of these probably. So obviously DM and Facebook, and then more recently, we've got a few slides on Terra Luna, just for those of you not familiar with that, to just explain what happened there last year, because I think this is relevant in thinking about stablecoins as a sort of viable means of payment. And then just very quickly in terms of how stablecoins compare to other crypto assets, hopefully you'll be familiar with this. So the main message here is to try and reduce some of the volatility, in theory at least, so they're not volatile at all. But as we'll see, that's not always the case. Okay, so just to level set on the different types of stablecoin, because this is highly relevant, I think, when we think about stablecoins as a means of payment. We have basically four different types. There's lots of other names that are used for these different types, like on-chain and off-chain and alike, but I just try to keep things simple. I'm a simple person. I like nice pictures and putting things in buckets, as you'll see. There's many buckets through this presentation. And we'll talk a bit about what each of these four types of stablecoin is and how it works. So first type, simplest one, a fiat-backed coin, so something like Tether or Circle's coin USDC. These are the simplest to understand. They've just got some fiat, so some US dollars, euro, some other currency that's in reserve, in a portionate reserve. Nowadays, there's an expectation that it will be at least a 1-to-1 reserve. So for every, one USDC coin, there is a $1 US reserve sitting there backing that asset. And there's been a lot of disclosures that a lot of these issuers have put out to justify and to demonstrate the reserves that they've got. So fiat-backed stablecoins. The other type of sort of backed stablecoins, if you like, are commodity-backed stablecoins. These are typically going to be backed by something like gold, let's say. That's probably the most familiar. And again, this is a reserve, and it's kind of, I guess, a digital way of saving you having to hold the gold bar, is the way I would describe this. There are some other stablecoins that are basically backed by other crypto assets, and the way these typically work is you would use a smart contract to sort of lock up the crypto asset. So let's say we've got some ETH, you would lock that up in a smart contract, and you would get something in return. And the DAI stablecoin, for example, is an example of a crypto-backed stablecoin. So I lock up my ETH and I get the DAI stablecoin, and then I can use, I don't know, let's say to back some other smart contracts, or I can use that for trading or even for payment. And then probably the most controversial type of stablecoin, and the ones you may have heard of, are algo stablecoins or algorithmic stablecoins. These work really by adjusting the supply of the coin to try and maintain some sort of peg. So typically they're going to be pegged against a currency, and where the price moves above the peg, you increase the supply, and below you decrease the supply. So effectively to try and maintain the peg. Not dissimilar to, for example, other instruments where you're trying to get some stability in the value work. We've got a couple of case studies on the algo stablecoins later, particularly Terra Luna, because that is there has been some challenges here, I think, in maintaining the peg, as we'll see. I mentioned I'm a simple person, so that's 4 buckets. Obviously, the world is not that simple. I could have put up a slide like this, and I could have put up a slide with about another 30 different boxes from different names and various other taxonomies that are used. But I wanted to sort of level set on the different types of stablecoin that we see. The two main buckets, I think, to put these in are the backed stablecoins, where there is something sitting behind the stablecoin, like gold or fiat or crypto assets, and then the algorithmic stablecoins. So they're the sort of main buckets that you would put these in. Any questions just on that level setting? That may have been very familiar to you. It may have been new to some of you. Okay. So just a few slides just on the sort of market before we get onto the payment question. So stablecoin market is really actually quite global in nature. The dominant stablecoins really are still US dollar denominated coins, and Tether, I think, is by far and away the stablecoin that dominates volumes. The ECB has got some really actually helpful and quite accessible analysis on the stablecoin market. I just pulled a couple of charts from a report from a few months ago on this, but it just shows you how significant Tether is as a part of the overall stablecoin market. Stablecoins are typically actually held by large investors. So I know we're talking about use of stablecoins for payments in this session, but actually, certainly retail holders of stablecoins is a pretty low set of holdings. These are mainly the large investors that are using stablecoins, for example, to settle smart contracts. So not really for sort of payment purposes in the way that we're talking about them today. And then just to position the sort of payment use case in amongst the broader use cases for stablecoins, it is actually only one component of the overall use of stablecoins. A lot of these use cases will flow from the use of things like smart contracts and alike. So payments is one. I guess you would put that in either the medium of exchange or store of value or remittance kind of buckets, depending on, I guess, why you're using the stablecoin for that purpose. Okay. There's various different use cases I've just put here. If you want to actually go and explore these in any more detail, probably certainly Tether and Circle are the two places that I would go to for sort of resources on stablecoins on the market. If you're looking to find out any more kind of information, lots of information on their website. Okay. Sorry, Natasha, to take just a few minutes in level setting there before we get to the sort of payments question, but I've only been working in crypto for about 10 months or so, and even now assume everybody knows everything already, and that's absolutely not the case because things move so quickly. So let's get on onto the topic of stablecoins as a means of payment and a sort of critique of this. So first question for me always is, why are we bothering to even talk about this? A few things. Speed of payments. Are there any opportunities here for stablecoins to increase payment speed? Privacy. Does that matter? Is that important? That stablecoins might provide greater user privacy. And innovation. And the Bank of Canada have done a really good paper on sort of benefits and risks of stablecoins. And just to position some of this already, if we talk about increased payment speed, the very reason why we had the first presentation today is because we don't have widespread instant payments at the moment. So the market has developed over time because that doesn't exist at the moment. Will that exist in 2 or 3 years' time? Privacy, we've heard about that from the digital euro. Is that important? To what extent are people using stablecoins because there is an additional layer of privacy that they get from using private money or stablecoins? And there are some really key considerations, for example, for the digital euro that we heard around maintaining that privacy as a sort of fundamental right. And then innovation, stablecoins are an enormous driver behind a lot of the decentralized finance innovation that we've seen. So if we're thinking about stablecoins as a means of payment, what sort of payments would we look at here? First is peer-to-peer. So I guess, a sort of digital version of each of us giving one another a banknote. We're transferring some value there without the involvement of an institution. Domestic payments generally feel easier than cross-border payments, and then cross-border payments, which is really, I guess, where we get some more of the frictions that we see in terms of speed and transaction costs. And then the other categories of payments that we probably would critique is micropayments. The traditional payment system doesn't work particularly well for micropayments at the moment because it's quite expensive. So as a portion of the payment, you're consuming a lot there in terms of fees. And then macro payments, where I think probably the fee rates are less important, given the traditional payment rails and alike for larger scale payments. So if we're going to make a case for stablecoins as a means of payment, what are the key considerations? So does it make any difference in terms of how quickly we can do the transaction? Does it make it any cheaper? What's the efficiency or the scalability benefit? And then can we redeem? Does this work in the way that we expect? Does it work as efficiently as with cash or other payments? And this is from the ECB's paper on basically stablecoin risks and policy considerations. Okay, so there are kind of considerations, I think, for are stablecoins a good means of payment? What are the potential benefits? So if we're going to conclude that they are, then surely there needs to be a scalability and efficiency benefit. There needs to be economies of scale, and I guess that means a reduction in cost the more that a stablecoin is used, and then potentially some sort of stability in value. And I think it'd be very difficult for me to stand up here and say Bitcoin looks a great means of payment because of the stability that it's got in its value. I think that would be, even for as someone as convincing as me, that would be really difficult to justify. But they're the potential benefits, at least. Let's look at the other side of the coin. So what are the, hopefully this moves on, yep. What are the potential drawbacks? So the ECB, I thought I'd include this because it offers, I think, an interesting central bank perspective on stablecoins, given perhaps the work that we've heard the ECB doing on the digital euro. So there's a paper on drawbacks for cross-border payments. So concerns about potential market power. I think this is one of the reasons why the digital euro project was initiated. I think we've heard is the concern about maybe Facebook becoming very successful in pursuing their stablecoin project, and what's the impact of that, and the network effect. So this theory around exponential growth over time. Financial stability issues. Risk of currency substitution. So again, we've heard a lot about this. So what would it mean if 50% of all payments made by EU citizens were made through stablecoins and not fiat? Does that matter? Threats to monetary sovereignty, fragmentation. So what would that mean in terms of different private money sitting alongside sovereign money, and then some of the AML and other illicit finance concerns. So they're the kind of potential drawbacks. Okay, so how do stablecoins stack up then against some of these kind of considerations? Well, actually, at the moment, what we see, certainly in the payment landscape, is this pretty limited use of stablecoins as a means of payment in the EU. And where we see payment service providers offering stablecoin services, they're generally going to be offering US-pegged stablecoins rather than Euro-pegged stablecoins. There are some Euro-pegged stablecoins out there, but in relative terms, they're pretty limited. So if you look at someone like Cello, for example, which has a Euro stablecoin, there's not considerable kind of market penetration there and not widespread use by PSPs. So at the moment, at least, we haven't seen that piece of the market develop. The other key consideration for us was speed. So does blockchain technology at the moment, do stablecoins offer transaction speed benefits? And certainly the ECB work on this suggests two things. Firstly, that there is actually pretty limited benefits in terms of transaction speed at the moment, but real variability as to the speed at which transactions are processed, even on the same blockchain networks. So I think one of the considerations, at least for payments, is managing expectations that a payment I do at one point in time, give or take, operates at a speed at a payment I do, let's say, a week later or 2 weeks later, etc. And you can see here just some of the challenges, I think, in terms of scalability at the moment, at least through some of these blockchain networks, and the constraints on the number of transactions that can be processed. There's often a sort of comparison made here, for example, to sort of MasterCard and Visa, the speed at which those networks can process transactions versus, let's say, the speed of the Bitcoin network, which you'll see on the right-hand side there is not even a bar on the chart. We probably need a logarithmic scale to even show that. So at least transaction speed, not considerable benefits from stablecoins at the moment. What about other considerations? So transaction costs actually vary really considerably. Some analysis I've looked at shows that certainly the larger stablecoins, the transaction costs are comparable to some of the MasterCard and Visa payment costs at the moment, but in the majority of cases, transaction costs are actually higher than, for example, let's say we see for an ATM cash transaction. Tether is I think the case where we see rough comparison between stablecoin fee transaction costs and fiat transaction costs. But if you look at something like the Circle coin or the DAI coin, they're about 3 or 4 times more expensive on average, those transaction costs, than for the fiat transactions we see. So, in other words, scale really does matter. And there's some really interesting academic analysis on this, which is updated quite regularly, showing some of these transaction costs side by side. Okay, a couple more slides on kind of the comparison for stable coins. The other really significant issue, which is being addressed through some of the regulatory reforms we see, are the ability for users to actually redeem stable coins. Typically, there are restrictions on redemption. Now, to some extent, this doesn't matter if you've got liquidity. You don't kind of care that you can redeem the stable coin if you can just sell it to someone else and they'll pay you the value. But certainly, the regulatory reforms we see are going to de facto require redemption on demand. So this issue, in theory, will be resolved over the kind of coming period. There's also a lot of differences between stablecoins and other components of the payment system. For example, things like chargebacks, compensation for fraud, which we heard earlier, where you don't really find many jurisdictions, if any, actually, have introduced those features for stablecoin payments. Okay. The other piece I couldn't leave out really when we talk about crypto and private money is this question of privacy. I'm just going to put this out there as I think a consideration here that stable coins by definition provide certainly pseudonymity or greater privacy to the originators and beneficiaries of transactions. If you're using service providers, you're going to be subject to AML and KYC, but you're not communicating your identity to the other party in the transaction through using stablecoins in the same way as you might through other payment mechanisms. I think it'd be very interesting to see how certainly the digital euro, the industry component of that develops. I think the ECB's design principle for this is quite clear, but it'll be very interesting to see certainly how the public reacts to that at a policy level. I wanted to just reference a couple of the market events which you may well have heard about and read about in the stablecoin space, because these are relevant in thinking about some of the challenges for stablecoins in being used as a means of payment. Probably one of the most significant recent cases was the what's called the Terra Luna case. This was actually a US-denominated algorithmic stablecoin that broke its peg, so the peg of the $1. That was broken in May of last year, and really quite a considerable loss of value. That was the Terra protocol and the Terra US dollar stablecoin. The Luna bit of this was actually the token that was used as a reserve asset that sort of backed the stablecoin. So if you remember earlier, I described a stablecoin where it had some assets backing the stablecoin. This was an algorithmic stablecoin with some crypto assets that were backing the stablecoin. And before the crash, Luna was actually one of the top 10 cryptocurrencies. I think maybe the third, possibly even by market cap. And the collapse wiped about 45 billion US in a week. Now, in terms of what caused this, that could be an entire conference in its own right, but the executive summary of what caused it likely is there was a linked protocol called the Anchor protocol, and the Anchor protocol was a lending and a borrowing protocol. But there were effectively concerns about that and about the fall in the value of Bitcoin that resulted in a really significant withdrawal from that Anchor protocol, and then that had knock-on effects to the Luna coin, which then had knock-on effects to the Terra coin. So that the kind of message here is, I think that certainly with some of the stable coins where you have the assets backing those stable coins, it's important to look through and understand the sort of process there, the algorithm, the assets, etc., that are backing those stable coins. I've got some charts just to sort of show really how quickly the situation sort of developed here. On the Anchor protocol, that was this lending and borrowing protocol, just really in the space of about 4 or 5 days, really considerable, so something like about 10 billion, I think, US came out of that protocol. And if you look at the price movement of what should have been a stable coin pegged to the US dollar, you can just see how significant the price change is on the stable coin. So this I think shows how some of the market events can flow through to particularly some of the algorithmic stable coins. That was in May of last year. The other actually more recent event I just wanted to use as an example to show how actually some of the stablecoin mechanisms can work effectively was with the Circle stablecoin last month, which at the time that the Silicon Valley Bank and the Silvergate bank failures occurred in the US, there was, because of the perceived exposure of the crypto sector to those banks, actually a really significant depegging of the Circle stablecoin. But you'll see from this chart that the days are on the bottom there, so the 8th to the 13th of May. Actually, the peg was restored relatively quickly because of the mechanism that Circle uses and the support that they provided to the stablecoin. And it's interesting to sort of compare this, I think, which to some would argue maybe is a more significant economic event with the failures of those banks, and how quickly the coin was able to restore the peg. Okay. I had just 2 more sections just to cover off. Just a brief word on Bitcoin, because I know this session is about stable coins, but everybody thinks about Bitcoin when they think about the crypto sector. There's certainly a lot of volatility in the Bitcoin price. It's not a stable coin. It's not issued by anybody, so it's a decentralized crypto asset. So the question is, could it be used as a means of payment? Um, the person that actually received the first ever Bitcoin transaction back in 2009, I think already answered that question. Because of the way in which Bitcoin works, there is a really significant issue in terms of scalability. So I have, just for a bit of fun, actually bought something which was a mobile phone case using Bitcoin just to test this out, and the transaction took about 10 minutes to confirm. So you know when you're on the checkout window on the website and you push the button, I actually did that and it kept refreshing, and 10 minutes later the transaction confirmed and I completed the checkout process. So I just wanted to use this as an example of kind of why something like Bitcoin wouldn't be suitable as a payment mechanism in its own right. However, there is a solution to this problem. This occurs because of the way effectively the transactions are broadcast, and that gets into some of the issues we talked about just a moment ago. The actual network can act pretty quickly. It can process about 7 transactions per second, but the issue is the confirmation of those transactions. And often, because of the way the network works, you don't always get your transaction confirmed that quickly unless you actually pay a higher fee to do so. So, in other words, Bitcoin on its own doesn't work as an effective means of payment. There is a solution to this, which is something called the Lightning Protocol, and this is a way in which we might see some of the other crypto networks being used more for payment means and as payment channels. It's really interesting to look at this, but just the shorthand as to how this works. This effectively groups transactions together and then confirms all of those transactions periodically on the blockchain. But it has a mechanism whereby, because it's grouping transactions together, when you have effectively a payment channel that is created between 2 individuals, you can get instant confirmation almost instant confirmation of the transaction. So this is an example, I think, of some of the sort of innovations that you might see developing in the future on the various blockchain networks. Okay, I am going to skip through the programmable money because helpfully, Panos, I think you mentioned that previously, and I just wanted to say a couple of words on stablecoin regulation in the EU. Yesterday, the European Parliament voted on the Markets in Crypto Asset Regulation, or MiCA, which has been about 4 or 5 years in the works. So that means this will now be published in the official journal and enter into force in the next couple of months, with the compliance date probably being the middle of next year for stablecoins. This is really significant because it really touches all of the different pieces of the ecosystem. It touches the users of crypto, the wallets that are used for crypto, the issuers of the coins, and also the service providers that facilitate the transactions. MiCA covers stable coins, and here's my buckets again, by splitting them up into a couple of different categories. We won't go through these in kind of detail, but stablecoins will either be what's called an asset reference token or an e-money token, depending on how they're backed. And what is also very significant is that MiCA also, based on various criteria, will define stablecoins either as regular stablecoins or as significant stablecoins. And effectively, the criteria is a qualitative and quantitative assessment of the use of the stablecoin in various transactions. So MiCA is going to really change the landscape for stablecoin issuers. Lots of additional requirements around things like disclosure, but also requirements around holding reserves, so the one-to-one reserves that I was mentioning earlier, and a requirement to basically offer redemption at request. It's not quite like that, but the MiCA is really raising the bar in terms of the requirement for issuers. There's a whole set of additional requirements that will be imposed on the issuers of significant stablecoins as well, basically enhanced governance requirements, more detailed disclosure requirements, and a requirement to issue and redeem at par. So really quite a different landscape for stablecoins compared to that at the moment from a regulatory point of view. I just wanted to very briefly touch on what's going on internationally. So there's a whole set of international work, the Financial Stability Board, CPMI, and BIS, and actually IOSCO. Those various organisations have put out recommendations and principles for global stablecoin arrangements. And in the US, there is a significant political impetus to actually develop stablecoin legislation at the moment. So we may see, I think, some additional requirements being introduced, not just in the EU, but more broadly. So just to sort of conclude, and then we can come back to the questions maybe. So hopefully, as you can see, stablecoins have got some pretty interesting attributes that do make them suitable for payments. But there is a question, I think, at the moment as to whether they offer really the potential for cheaper and faster payments based on the current infrastructure and sort of use cases. But undoubtedly, they're offering, I think, the benefit and the potential for innovation. And for example, the Lightning Network on the Bitcoin that I was talking about just a moment ago is a good example of how that innovation might play through in the future. But it's really going to depend, I think, on how the infrastructure develops and also, the regulatory reforms such as MiCA to determine the extent to which stablecoins are going to be able to evolve as a means of payment, particularly alongside things like the digital euro, the instant payment proposition that you've seen. If we were to come back in 5 years' time, would we see a different market for stablecoins or not? I guess we'll need to see. Thank you.